So I lost money in three stocks yesterday. So I call them scratch trades. The reason why I call them scratch trades is because I make an attempt to buy the stock. And if the stock does not give me price and volume confirmation, then I immediately close the position. That is called as a scratch trade. This is a risk management strategy that I use, to control the amount of money that I give away to protect my realized gains. If I continue to book large amount of losses, then it will eat into my realized gains. I don't want that to happen. So I'm okay with booking losses, but I'm okay with only with booking small losses. Okay. So let us look at these three trades. So first one is CDSL. The stock closed above the yellow line. However, during trade execution, I faced some problems which I will discuss with you here. So let's go to CDSL. So look at this. This kind of candle is very difficult to trade. Okay. So my buy point was here. So this is the high of this candle is 1570. 1570. Okay. And if I draw the points in the base, see, this is point 1, and that's point 2, that's point 3, point 4, point 5, point 6, and point 7. I don't take this candle because that was yesterday's candle. So this is what I saw. So there are 6 points in the base, and the yellow line is in the blue zone, which is ideal for me because 6 points is a good amount of consolidation. So I decided that on the yellow line, I will buy the stock. So just above the yellow line, I placed a 1% level. So 1570. Let me pull out my calculator. 1570 multiplied by 1.01. That's 1585. So I placed another yellow line at 1585. So this is my second yellow line. So my goal was to buy the stock on this day as it enters that yellow band. Buying below that yellow band is like buying the stock prematurely. Buying above the second yellow line is like buying an extended stock. So my goal was to buy it within that band. So let us go to the 15-minute chart to see how I tried to execute the trade. So this is the first candle of the day. This is yesterday's session, first candle of the day. And see, the moment the price started trading one tick above the yellow line, I decided that I will buy the stock. So I started buying my shares here gradually. I started buying more as price and volume started to come in very fast. Look at this volume bar. It's almost 10 times the average daily average volume on the 15-minute chart. So within just a few points, I ended up buying all my shares that I had planned to buy. Okay. The moment that happened, after I got my shares, after it moved up above this second yellow line, I decided to keep my stop loss at the first yellow line. Before that, I was just watching the trade during those 15 minutes. In case if it traded one tick below the yellow line, I would have closed the position. And by the way, this was the day of the elections in the US. So this stock was comparatively, technically, and fundamentally strong. Generally, a stock which is comparatively, technically, and fundamentally strong, I would give it more room. But this particular on this particular day, I decided that the market could be volatile because these are big eventful days in the market. So if I am anticipating a volatile day, I choose to micromanage the trade. Ideally, this trade I would not have micromanaged, but I decided that on this day I will micromanage because I don't want to get shaken out because of volatility. So that is why I decided that although this stock is perfect in every way, fundamentals, technicals, comparatives, even volume is good on the daily time frame chart. So I decided that since it is election day, I will micromanage. And the stock started to go up. Then it went up even further, and then it started to collapse. Okay. So my stop loss was here. I got shaken out here. My loss was minuscule. Okay, because I had already made my purchases here. In between these two yellow lines, if we draw a midpoint, all of my shares I had got below the midpoint. Okay, in between the yellow band. So that is why my loss on this trade would be less than 0.5%. 0.5% of position size, not of portfolio. Okay, my position size here was 6.25% of my portfolio. There is a big difference between 0.5% risk on portfolio and 0.5% risk on position size. I am talking about percentage risk on the money that I have invested in the stock. Okay, so don't get confused. You need to have clarity about risk. When I say portfolio risk and when I say position size risk, these are two entirely different things. So I got shaken out and my risk was less than my loss was less than 0.5% here. Then it started to pull back. Okay, this is what happens in the market. It goes down, shakes out the weaker players, and then it pulls back and starts to move up again. So as it was pulling up again, if we draw a midpoint line here, I ended up buying back the shares that I had sold because the stock was now showing strength and volume also came in above average. So I ended up buying back the shares that I sold. So this is my second attempt on the stock. And again, as this candle closed, I immediately kept my stop loss at the yellow line. So this is called as micromanagement. This is called as risk. I am not willing to give away much of my gains here. Okay, much of my money here. Okay, this is to protect my realized gains on my previous trade. So everything is like kind of linked here. Okay, so I bought it here, kept my stop loss, and for several candles, this is like multiple hours during the day. Several candles, I was waiting for the stock to go up, but there was just no traction in the market. Okay, maybe the market went sideways. The election counting was going on during this period, and I got shaken out again. So on the second attempt, I failed again. Again, the loss was less than 0.5%. So if we take the combined effort of these two attempts, okay, total loss would be in the range of, say, 0.5 to 0.6% on position size. Okay, if I add both the two losses. Okay, so let's take it around 0.5 to 0.75% loss on this trade. Although if you see on the daily time frame, it closed above the yellow line. See, the candle closed above the yellow line. The candle closed inside the yellow band and the volume closed above the blue line, which is ideally what I expect. However, this is not a true breakout. A true breakout is where this kind of volume comes or this kind of volume comes and the candle comfortably closes above this entire yellow band. According to me, that's a true breakout. Okay. Now, I would expect a baby candle to form today because I'm recording this video today morning, which is 7th of November. So if I get a baby candle here, now I have another buy point here. So 0.1, 0.2, 0.3, 0.4, 0.5, and the low of the baby candle would become my point number 6. So I would take another shot at this stock because now I am buying with 6 points from the green zone. Earlier, I was buying with 6 points from the blue zone. So my risk is now reduced. So the setup is actually improving. Although I have lost money, but the setup is actually improving. The base is still intact. The low of the base is not shaken out yet. The moving averages, the 50-day, the 150-day, and the 200-day is in line. The price is above all the three moving averages. Okay. By the way, the 150-day and the 200-day are called as long-term moving averages. The 50-day moving average is called as the intermediate term moving average or the medium term moving average. And the purple line, which is the 21 EMA, and the orange line, which you don't see here, orange line, which is the 8 EMA, these are called as short term moving averages. So, short term moving average, medium term or intermediate term moving average, and long term moving averages. The purpose of long term moving averages is to identify whether the stock is in stage 2 or not. The purpose of intermediate term moving average is whether to stay in the trade or not. It's swing or positional, mostly positional. And the purpose of short term moving averages is to manage the trade. Okay. I will make a separate video on moving averages. But you see, I ended up selling the stock. There is a rising window here. By the way, don't consider this as a recommendation. I am not recommending that you buy the stock at the high of this candle. Whatever I discuss on this channel is for educational purposes only. I have looked at several other factors before I came to this chart. Okay. I looked at Market Smith ratings, rankings, the earnings, the sales, the fundamentals, the technicals. After that, I have come to this. So you have to do your own due diligence before you buy a stock. So this is one stock where I lost money, even though the stock closed 2% higher, but I ended up losing money. Okay. Next stock where I lost money is Garware Hi-Tech. I made an attempt to buy this stock. See, this is a nice base, 0.1. Wait. 0.1, 0.2, 0.3, 0.4, and 0.5. So at point number 3, which is in the green zone, I put the yellow line, and the second yellow line is 1% above the first yellow line. Now, if you notice here, there are only 4 points in the base. I don't consider 0.5 as a buy point because 0.6 is not completed yet. That wave has to complete. So 0.3 I have taken as the buy point here, which is 4153.60. So I am okay with 4 points in the base as long as the yellow line is in the green zone. But I am not okay with 4 points in the base if the yellow line is in the blue zone. If the yellow line is in the blue zone, I want minimum 6 points in the base for me to comfortably take the trade with confidence. Okay. So again, this stock again closed above, it closed positive, it closed above the yellow line. However, I got shaken out of the trade. Look at the volatility in that candle. Look at the upper and the lower shadow. It's extremely difficult to execute such kind of trades. Okay. That is why this is another reason why backtesting does not work for this strategy, because let's say you are looking at a breakout which happened 1 year ago. Now, there are two problems with that backtesting. You might look at the breakout and get excited. Okay, the stock broke out and from there it went up 100% and you get very excited about this strategy. Well, the problem with backtesting is if you go back 1 year, okay, at that time when that breakout happened, you don't know what was the relative strength of the stock. You don't know what were the market conditions uh, of at that time when the breakout happened. Maybe there were elections happening during that time. Okay, so you don't know the relative strength. You don't know the group rank. You don't know the market conditions or the sentiment at that time. Okay, that is one problem. Another problem is you don't know how you would have executed that trade on that particular day on the 15-minute chart. Okay. You also don't know what position size you would have taken because you could change your position size every couple of weeks. There is nothing wrong in doing that because your ability to tolerate more risk increases as you get more and more profitable trades. Your ability to tolerate risk decreases as you have more and more losing trades. So how do you know that when that breakout happened 1 year ago, what is the position size you could have taken? Okay. Or where would you have kept your stop loss? So this is the problem with backtesting. So that is why I discourage you from doing any backtesting. Beginners are the ones who do backtesting and professionals are the ones who manage their risk. Is as simple as that. Okay. So take that lesson and focus on what you see on the chart right now. Forget about any backtesting or anything. All we have to do as professional traders is to stack the odds in our favor and take the position and manage the position. That's it. That's all you have to do. So let's go to the 15-minute chart. Look at this. Look at this first candle. Okay. So ideally, I should not have bought this stock. Okay. Ideally, I should not have bought this stock because it opened above the it opened above the yellow line. I see if it opens above the first yellow line, I never even look at the stock. Okay. So since this candle has opened above the first yellow line, I did not buy on this candle. Second candle, of course, it is below the yellow line, so I did not buy. But have a look at this candle. If you look at this candle carefully, it is creating a pullback. By the time this candle reached this high, okay, I was looking at a large green, something like this. Okay, I was looking at a large green candle. See, before this shadow gets formed, the price has to touch that level, right? So when it is touching that level, you are looking at a strong positive green candle, which is probably breaking out of the yellow band, and that too on high volume. Look at this high volume. So I ended up on this candle, I ended up buying the stock. Again, same way as it traded one tick above that first yellow line, I ended up buying the stock. The stock went up near here. I immediately kept my stop loss at the yellow line, came down and shook me out. I never saw these candles. One, two, three, four, five. I never saw all of these candles. So this is almost a break-even scratch kind of a trade. There's hardly any money lost in this, maybe 0.25%. Okay. Hardly anything. And that too on position size, not on portfolio. So if we look at this, let's say 0.25, I would say it would be less than 0.25%. So 0.25% money lost here. Do you understand why did I not buy on this candle? Because any any stock that opens above the yellow line, you run the risk that you might buy and the stock might close below the yellow line, which is exactly what happened on that candle. So I never buy a stock which opens above the yellow line. Take that as a rule. Okay. And so 0.25% lost here and 0.75% roughly lost on CDSL. Another stock where I lost money is, and by the way, this all happened in one day. Okay. So have a look at this. Now I will not show you let me show you the daily chart. Okay. Have a look at this. Perfect, nice breakout. Okay. 0.1, 0.2, 0.3, 0.4. The only problem with this is that the buy point was almost in the blue zone. So it's a nice breakout on high volume. So you might look at this stock and say, Rohit, this is a perfect classic breakout. However, look at trade execution. See, trade execution is extremely important. Okay, see, first candle I did not buy because it doesn't touch the yellow line. Second candle did not buy, doesn't touch the yellow line. Have a look at this candle. Okay, now it trades one tick above the yellow line. I buy. It starts to go up. I immediately keep my stop loss here, and it kicks me out of the trade. Very small loss, even less than 0.1% or 0.25%. Now you tell me, I have already lost money on this candle. Do you think I will take a trade on this candle? Do you think that after losing money on a couple of trades, do you think I will take a second attempt on the third stock? This is another trading psychology I want to discuss with you when it comes to trade execution. When you are already losing money on two stocks, will your psychology allow you to take a second attempt on the third stock? Okay. Now you already lost money on three stocks. So you have to control your risk. Although the loss is very small, I would say the total loss on position on 6.25% position would be less than 1.25% on all the three trades combined. So 6.25 multiplied by 1.25% is roughly like 0.06% of my overall portfolio, is less than 10 basis points of my overall portfolio. So which is nothing, minimum loss. That is why I call them scratch trades. However, from a trade uh, execution point of view, your mind will not allow you to take that trade. Okay, so that is why I did not take that trade. I just wanted to control my risk. Okay, and that's exactly what I did. But then it went up, closed higher, and that too on high volume. But did I know that this was going to happen? I did not know that beforehand. So you have to do things at the moment when the market, then things are happening in the market. You can't look at such breakouts in hindsight and say that, oh, I missed this breakout. No, no. On or at the time of trade execution, you have to see what was going on and what is the best you could have done. Okay. So never carry any regrets when you look at such kind of stocks. Okay. So this video was more about the challenges that you will face as a professional trader when it comes to executing the trade. By the way, all three stocks were comparatively strong, technically strong, fundamentally strong. I will not take you to Market Smith because that will take a lot of time. That will make this video very long. But I'm just telling you that all the three stocks were comparatively, technically, fundamentally strong. I could have reduced this loss further by avoiding two stocks. One is Garware and one is Nuvama. Why? Because if you look at this stock, Nuvama, the average daily volume is less than 200,000 shares. So any stock which has an average daily volume of less than 200,000 shares, I consider that stock as a illiquid stock or less than optimum average daily volume. So I could have said that I don't want to buy this stock because it is low volume. If you look at Garware, look at the average daily volume. Okay, it is less than even 100,000 shares. Okay, so at least one of the stocks or both of the stocks could have been avoided. I could have said that, okay, my threshold is 100,000 shares traded per day. So I could have avoided one stock, which is Garware. I could have taken Nuvama, which could have reduced my loss. But look at CDSL. CDSL is a very famous company. Look at 4 million volume. Okay, 4 million average daily volume. So it's much beyond the volume of Nuvama and Garware. So volume plays a big difference. If the average daily volume of the stock is small, you can get shaken out of the trade in that 15-minute time frame period. I stick to 15 minutes because that gives me uh, proper time to manage the trade. 5 minutes is too early and 1 hour is too late. 15 minutes is the optimum time frame that I use. So I hope this video has added value to your trading journey. And I encourage you to please share this video with your friends, family, and business associates. I think there is extremely valuable information being presented in this video. You, as a professional trader, will definitely face these challenges because if you don't manage the risk, if you just buy the stock and keep your stop loss at some level below or inside the base, there is a good chance that that stop loss might be taken out. And especially one point I forgot to mention, especially when the general market indices have been falling for the past 3-4 weeks, a lot of money has gone out of India in the past 3-4 weeks. Those are the times when you have to be extra cautious. In a rising market, I could have given more room for the stock to fluctuate. I could have given them more time and more room to fluctuate, but not in this market. Okay. That is why I'm keeping my losses low. And if you notice some of my past trades, you will notice that my losses are minuscule, but my gains are a multiple factor of my overall losses on position size. Okay. That's what trading is all about. You have to stack the odds in your favor and you have to sell on strength. Okay. Because those are the profits that will help you finance your losses. So please share this video with people who genuinely want to become professional stock traders. I think Indian retail traders need this kind of genuine information. So thank you for your support on this channel. Thank you for your precious time that you are giving to this because my videos are generally long. And if you reached till here in the video, that means you are a dedicated trader. You genuinely want to learn this. Thank you so much. If you have any doubt, just send me email, WhatsApp, whatever. We'll catch up. Thank you so much again.